what exactly happened. No worries. And talk about sort of what we've just all experienced together. Um, Section 4, insights, thoughts, and predictions for 2024. So again, sort of a window into the data, what we're seeing going on now, and then I'll give you some personal thoughts about what I think will happen sort of in the second half of this year and beyond. And then I just wanted to walk through a couple of actual transactions that our team has closed in recent months to give you an idea of sort of real time, what kind of projects we work on, what makes a great referral, et cetera. And then I'll leave it open to discussion and Q&A. So, but again, Q&A, not just for the last half. If there's something that crops up or something you don't understand, something you want more clarity on, please feel free to raise your hand, interrupt me. So this is uh, myself and my wife, Nicole. Jim will be a very proud papa here. My wife is Jim's daughter, so Jim is my father-in-law. You can see we love to travel. The middle picture is actually us on our honeymoon in 2016. And on the right, you can see us in front of Chateau Haut-Brion in Bordeaux. A lot of our travels to date have revolved around food and wine. We love to experience different cultures, and oftentimes we find that through eating and dining, it's a great way to experience different countries, different places, and so we love to travel. We still love to travel. But in August, excuse me, we were welcomed with our first baby boy. So this is Cody James, which also is a allusion to James Litzis. And he has changed our life for the better. We still love to travel, but it looks a little bit different. So we made a trip up to Paso Robles with the little guy. You can see him at one of his first Chargers games at SoFi Stadium in the middle. And then on the left, my family's all on the East Coast in Boston. And so we brought him back for his first trip to the East Coast over the Thanksgiving holiday. So a lot of fun. These are what drives me, why I get up in the morning. And this is outside of the family. We also like to have fun. I'm very active. I love to play sports. I love all things sports, attending sports. We hiked the Grand Canyon with a couple of friends. I still play basketball. I love to run. I take our dog out twice a day to go hiking. So love to stay active, love to sort of just be out there enjoying the Southern California weather when it's not raining. And now hopefully I'll have a little sidekick to go with me going forward with Cody. So that's just a little about me and our puppy, Pino, who's now going on 3 years old. So get to know Walker and Dunlop. So our mission statement, I think, really sums it up, what we do just on a sort of a greater level. We create communities with ideas and capital where people live, work, shop, and play. So everything we do is tied to real estate, but it's so much more than that because we're fueling ideas that are creating all the places that we go to spend time with family and to shop and to eat and just to enjoy life as we've created it. So what does that mean? What do we actually do? We have a couple of different verticals that we play in. Where I sit and where we'll spend the most time is on the finance piece. So we are a financier of commercial real estate. We also have our own investment sales team nationally. They only sell one product type, which is large scale multifamily, pretty much Class A, 250 units and above. So really institutional quality product that's being traded out in the market. We do have an in-house appraisal firm known as Apprise. Again, they specialize in multifamily appraisals. So if you are working on larger multifamily transactions for your clients, we'd love the opportunity to be your appraisal firm. Investment management. Basically, what this means is we're putting ours and other people's money to work. So we are a direct lender. We have our own balance sheet lending platform, which we'll dive into. And we also are putting equity out in the market in the form of preferred equity, mezzanine. We've also done some co-GP joint venture deals where we've acquired assets as a firm. So we are playing in that space as well. Investment banking, I note this is a newer piece. It actually ties in with our research piece. We acquired a firm called Zelman and Associates just a couple of years ago. They're actually the largest aggregator and distributor of data in the single family market, both for sale and for rent. And so with build for rent becoming a really white hot asset class, we thought it as a really natural acquisition target, but they've been instrumental with us because of all their data for sale housing, which really drives the multifamily for rent housing market as well. So it's been a wonderful marriage. And so we have a lot of different services that we've expanded over the last really 3 years, which we didn't have prior. And so that's been a really interesting part of the business to see grow as well. So I'll give you a little bit of scale about our company. On the finance side, in 2023, I just updated these numbers. We did 24 billion with a B in debt originations. That's both as a direct lender and as a broker. We have one of the largest servicing portfolios in the country, which now sits at about 131 billion. So we have a lot of data that we extract and mine from that, which is a huge competitive advantage as we're working with your teams and your clients who are looking for data on properties that they're buying. We typically are servicing properties that are down the street from them, and we can compare notes, pull comps, etc. The investment sales volume, as we all know, was much lower in 2023 than it was in 2022. So we just hit about 9 billion, still a pretty large number. And we're one of the largest investment sales brokers in the country. And again, we only sell one asset class, which is multifamily real estate. The valuations has gone gangbusters for us, 120 billion in value of assets appraised. We're actively trying to grow that. We'd like to be the leader in appraisal firms nationally. So please think of us for things like that. And you can see the other AUM for our investment management business and our investment banking transaction volume. So we play in a lot of different spheres. Again, we'll spend most of our time on the finance side. And that's what we'll dig into now. And so on the debt origination side, I put this separate because this is really what we are a principal lender of. So we are the largest agency lender in the country. Now, a lot of your clients will have heard of Fannie Mae and Freddie Mac because they are also the largest financier of and guarantor of single family homes in the country. But what a lot of people don't realize is they are actually the largest source of liquidity for multifamily apartment homes in the country as well. And we are the largest direct lender of Fannie Mae and Freddie Mac in the country. It's about 50% of our firm's business on the finance side. You can see FHA and HUD. They also issue commercial real estate loans on multifamily. And then our investment management debt, that's all proprietary capital that we have a couple of different buckets of that we're putting out into the market as a direct lender. On the debt and equity capital market side on the right, these are all folks that we either broker to or that we correspond for. And I use the word correspond, and specifically with our life insurance companies that we represent, about three dozen of them. And what that means is we actually originate loans on their behalf. They make the ultimate credit decision and put the capital out, and then we service those loans for them for the duration of it. So we're involved. We have a fiduciary responsibility both to the lender and the borrower in that relationship. So it's a little bit different than some of the others where we're just a straight broker. We broker to banks, we broker to credit unions, to CMBS securitized lenders, to debt funds. There's a lot of private equity firms that have entered the private capital space. And so our job is to be in the market talking to every lender under the sun for both debt and equity capital. And it's our job to put your borrowers and clients in touch with those people and to arrange financing when they're doing commercial real estate transactions. So what is it that we finance? It's a pretty long list. Really, it's easier to break down. Let's see if I start here. Where is that slide? So these are the 5 main food groups that we finance: industrial, hospitality, office, multifamily, retail. Obviously, office is in a very transitional period right now with work from home and hybrid work relationships. So that number I would expect to come way down in this year and coming years. The majority of our business has been in multifamily and industrial over the last 5+ years, and that's driven by market demand. They're just the 2 most desired asset classes nationally, and they're, for the most part, the easiest for a lot of folks to wrap their heads around as either first-time or sort of inexperienced buyers of commercial real estate. Our team actually here in LA, we specialize in doing a lot of retail, so we can dive into that, but we do a lot of strip centers. We've done power centers, a lot of grocery anchored shopping centers, We financed the last mall we did was in 2018, so it's been a little bit since we've done an enclosed mall, but we do have experience in that. And then hospitality hotels continue to be a really good performing asset class. I probably see that peaking here shortly. We can talk about a little bit of the hospitality sector in general, but those are the five main food groups. And then I break it down a little bit more here granularly. So within multifamily, there's a whole lot, right? There's conventional multifamily, there's affordable housing, there's seniors housing, which includes skilled nursing and Alzheimer's care facilities. There's student housing. We do a lot of manufactured housing communities, aka mobile home parks. BFR and SFR, so the build for rent and single family for rent communities that are sprouting up all over Texas, Florida, the Carolinas, Arizona. We're the largest BFR lender in the country. And so we do all of that within multifamily. And so we do a lot of acquisition financing, refinance financing, but we also do construction financing. So as people are building new projects, we're the ones financing those, putting the debt and the equity together. I mentioned industrial, you see that up here. I mentioned retail, office, hospitality, but then some other ones that we've been doing a lot of lately. Self-storage has really caught fire over the last 3 to 5 years as it expands into sort of secondary and tertiary markets. Condominiums have been really tough just because of the for sale housing market. As you all know, it's been tough to finance. We're still doing them in really good MSAs like New York City, Seattle, and some other places, but not as much as we had been over the last, call it 7 to 9 years. Life sciences, similar story. We had a boom, call it the last 3 to 5 years. That's really sort of plateaued and peaked. Data centers is a completely white hot new one with the expansion of AWS and so many of these Fortune 500 AI driven companies that need server space, data centers. A lot of investment is going into that. So we're doing a lot of financing on that side. And then here in LA, specifically studios, they continue to expand a number of different campuses in Burbank and North Hollywood. And so we've been instrumental in financing a lot of those. I put the type of loans on the right-hand side. I'm sure you're all familiar with, but if you have questions, we do fixed rate, floating rate, bridge debt, construction debt. So we play in all aspects of the financing world. And really all asset classes. But again, the majority of our business has been industrial and multifamily over the last 5 to 7 years. So we can skip through this. I mean, this is all just sort of a little bit more. This is more what I wanted to show you, just the scale of Walker & Dunlop. A lot of people are not familiar with our company. We are publicly traded. And in 2022, we were the 6th largest commercial real estate lender in the country. So I like to let that sink in because, a lot of people compare us to CBRE or Newmark, but when it comes to employees, we're only about 1,600 employees, but our volume is larger than all of these firms. And so our biggest competitors are actually Wells Fargo, JP Morgan Chase, Bank of America. It's the largest banks in the country because we're doing the volume that they are with about, 1/10, 1/20th the amount of employees. And again, that's because of our focus really in multifamily. We're just doing so much comparatively, specifically through Fannie Mae and Freddie Mac. So these are dated numbers. We haven't updated this for 2023 yet. So 2021 was a record year for us. 2022 was slightly below that. 2023, and we'll get into this in the presentation, but of course, as you all know, it was much lower, about 55% lower in total transaction volume. And so it's been a roller coaster for sure. We're still doing a lot of business, but just the overall market has shrunk for commercial real estate in general. And again, here we are, just number 1 GSE lender in 2022, number 1 with Fannie, number 3 with Freddie, number 2 with HUD. So big numbers, but again, a lot of people haven't heard of us. And the only other thing I like to comment, especially with Fannie Mae, it's not just a one-off that we were number 1 with Fannie again in 2022. We've been number 1 with them 8 of the last 11 years. So it's really the heart and soul of our company. So multifamily finance, most people just sort of, Walker & Dunlop has become synonymous with multifamily finance these days. Again, I put a couple of other ones here. Skilled nursing and assisted living is something that I've been doing a fair amount of financing for over the last couple of years. As we all know, it's a growing need here in Southern California and nationally as boomers age and are going into, they need more care and they need higher levels of care. And so this has become a much more developed asset class across the country. And so we're seeing more and more of it. In downtown Los Angeles, we just financed another parking garage. We've done private airplane hangars at Van Nuys Airport and also at Big Bear Airport. We've done co-ops. Ocean Towers in Santa Monica is the largest co-op in Los Angeles, and we financed that a couple years ago. So that is for sale homes, right, in a co-op structure. So a lot of people don't realize that Fannie Mae and Freddie can play in that field, but we did. And we did their master senior loan and master plan communities. So we do some financing of for sale housing in an MPC scenario. So again, there's a lot of places that we play. It's not just the traditional, apartment building down the block that someone's owned for 20 years. We get our hands dirty and we play in a lot of different nuanced asset classes. And so we work with a lot of the big institutions, as you can see, but the majority of our clients are private individuals, right? They're high net worth individuals, they're business owners that are generating cash flow, and then they're turning around, they're buying investment real estate to invest for the future and hold long term. So let's dig into the presentation a little bit, and I hope you'll find a lot of value here. So, we're just coming off of really a 13-year bull market cycle. From the depths of the GFC, commercial real estate volume has essentially climbed nonstop through 2022, with the only dip being 2020, which of course was the COVID-19 pandemic shortened year. And it's interesting to see, that knocked out about 4 months of the year, but we were on pace in 2020 to eclipse 2019. So obviously there was a lot of pent up demand in 2021, which is why you saw that as the largest year ever in commercial real estate from a transaction volume standpoint. But, other than, I would really call it a speed bump for the industry for 2020. You can see 2021 and 2022 just absolutely were on fire. And I just like to put this, COVID-19 year 2020, that was on pace with 2014 and before that. So, I mean, amazing to think, that in a year that really, most folks in our industry were working about half the year, that we did more in business than we did all of 2014. So what were people buying? I've called this an epic shopping spree. So look at the jump in multifamily and it's probably best here to compare 2019 to 2021 rather than 2020 because it was an anomaly year. But if you just look at that, I mean, almost doubled multifamily and industrial, right? So what happened was there was so much pent up demand. There was so much liquidity in the market. People had to go and buy something. And everyone started buying multifamily and industrial because they were the star performers. And so people that had historically bought retail and office and hospitality, even they pivoted their business plans and they started buying multi and industrial. And that included Blackstone and Starwood. And so this is just a wild statistic from Q4 2021 to Q4 2022. Between the two, B REIT and S REIT, which are the REITs, the privately held REITs of Blackstone and Starwood, between the two of them, they were buying about $100 million per day of multifamily housing, which added up to about $10 billion per quarter and almost $40 billion within that 1 year stretch just between those two firms. It's just an insane statistic when you go back and look. How did we get from 2019 to 2021? It's because firms like that raised billions of dollars, saw the opportunity to invest with cheap money at low fixed rates, and go ahead and just absolutely oversaturate the market and glutton feed on that asset class. So you can see 2021, Q4 2021, again, the largest quarter we've ever had as an industry, compared to Q1, Q2, Q3, and Q4 of 2023, way less than half, almost about a quarter of the production. So it's interesting. I was just watching Neil Bawa, if anyone are familiar with him and his team of Grow Capitus. They had a webinar, and they were talking about the amazing fact that the U.S. economy has avoided a recession following the rate hikes over the last year and a half. And I would lobby to Neil that the commercial real estate industry has been not only in a recession, but probably a depression for about a year following those rate hikes, where the rest of the economy has chugged along. So just because the greater economy hasn't experienced the pain, commercial real estate has really, really come off its highs and has been in a world of hurt. And a lot of people especially on the brokerage side, are just seeing such low transaction volume because of it. So as you can see here, about a 50% plus reduction in transaction volume nationally. And again, this is purchase and sales of commercial real estate across all asset classes. So you can see 2023, how much it's come down. 2024, we'll get into sort of the projections a little bit later in this, but interesting to see. So what happened? Core and headline CPI started running rampant in early 2022. But what happened was when we saw CPI and inflation run wild from early 2021 through mid 2022, there was no Fed response. So we had inflation running wild and all-time low interest rates. What does that mean? Well, inflation is actually good for values. It's great for rents because rents go up. And so if you have fixed rates that are at all-time lows and the values and rents at your properties are only going up, it's one of the best times to buy and to be an owner of assets. And so that's exactly what happened. That's why B REIT and S REIT saw this confluence of events and just started buying. It didn't matter what they bought because the money was essentially free. There was so much value that they were getting just by being an owner of the asset and watching rents go up that they really didn't even have to be operators. I mean, anyone could have done this business plan. And then, of course, Jerome Powell saw this and figured out that, wait, this is unsustainable. And that's when you saw the Fed funds rate start to be hiked to slow the economy down, to slow inflation down, and brought the Fed funds rate way up, way quick. And that led immediately to a regional banking crisis. It mismatched assets and liabilities on a lot of these banks' balance sheets. It caused a liquidity crunch that only the government or JP Morgan Chase could fix. And that really sent shockwaves through the market. So if you remember this in early 2022, this was a big point of volatility. A lot of people just said, whoa, I don't want to buy anything anymore, whether it be homes, commercial real estate, businesses, because people didn't know if the banking system was going to be in jeopardy and their deposits were in jeopardy. So let's take a look at the historical Fed funds rate and talk about Neil Bawa. Because as you can see, what's happened in the last year is the second steepest increase in the Fed funds rate in the history of our country. The only steeper time, as you can see, was about 1980, which Jim can recall was crazy inflation. Mortgage rates went up to 13, 14%. Savings rates were on the flip side just as good, right? 18, 19%. But what I really find interesting in this is not just the comparison of where we are today versus the historical norm, because it is nice to always put it in perspective. But what I find more fascinating are these gray patches of gray that are sort of periodic throughout this chart. These are recessionary periods for the U.S. economy, as described as a recession, GDP reduction for 2 straight quarters. And every time the Fed has raised the short-term Fed funds rate, we have hit an economic recession. There's one example that I can see here in 1985 where they raised and they didn't, and that was coming off that super deep recession, depression that the economy hit in the 80s. But so when Neil Bawa says, it's just amazing that we haven't hit a recession, it's typically because there's a lag time. And so as I'm looking at this chart, I'm bracing for recession some point in 2024. I know it's an election year, so I think the country and the politicians will do their best to avoid it. So if it doesn't happen this year, I have to imagine it happens next year. But it's just, it would blow my mind that this might be the first time ever we avoid a recession after having such a steep rate hike. So we use CoStar because they are a wonderful data mining, solution for commercial real estate. And I went back to Q1 of 2023, so last year around this time, and I looked at what CoStar predicted in their base case economic outlook for market cap rate by property type. And I thought it was pretty interesting. At the time, we all thought office was in a world of hurt, and their cap rates would go up and their values would go down. So that made a lot of sense. Hotels, they thought would hold firm and just keep plugging along. But they thought every other asset class would actually experience an increase in cap rate, a substantial increase in cap rate, including multifamily. They see it's almost getting to about 6% cap rate. But now we go to today's, we have 1 year of retrospect, and let's see, this is the exact same chart in the exact base case economic outlet. And all of a sudden, it's interesting. Multifamily is now at 6.5%, almost touching 7%. So it's run way further than even their base case economic outlook had thought. And when you look at the asset classes, office, it's actually not as bad as they had predicted. Whereas hotels, they actually predict to fare much worse going forward. So pretty interesting to see how things can change just with 1 year's time. But I do think this chart is representative because their base case that CoStar uses assumes a mild recession in the US economy. And so I think that's reflective here. Assuming we get some sort of slowdown economically in earnings and just across broad sectors, you should see cap rates continue to widen through the end of 2024 before stabilizing and then starting to come down in 2025 and beyond. CBRE tended to agree. They're a little bit bullish, more bullish than CoStar was because their cap rates peak at a lower number and then start to run back down to actually even lower numbers than before. So I thought that was interesting. But two of the largest data aggregators that we have are in pretty much consensus that this will be the track, assuming that there's no major depression-like recession or any other white swan event. And I include this again. I'll share this with the slides afterwards. Green Street is another great data that we use. This is for all asset classes across different markets. And so you can track what cap rates are doing based on actual trades quarter over quarter. And I just like to highlight a couple of these because I like their commentary as well. So in apartments specifically, transaction volumes remain low, but trades closed in recent months suggest cap rates are settling in the mid to high 5% range in many markets. Industrial. Since peak pricing, industrial asset values have fallen by 17% and cap rates have risen by 140 basis points. Strip center retail. Strip center values are unchanged since mid-December, but are down 18% since the peak in 2022. And then interestingly enough, single-family rentals. SFR values as measured by both owner-occupied and rental markets are only down 5% from peak levels. I thought that was pretty interesting. Talk about a well-performing asset compared to the broader market. This is actual cap rate data. I had to steal it from another presentation. This is from our internal investment sales team. But all it does is it reinforces the trend. This is the middle bar of each of these graphs is value add multifamily apartments, which is the biggest play where people are buying apartments. They want to buy, they want to renovate, and they want to boost rents. And as you can see, cap rates have increased over 100 basis points on that product type in about a year's time. So you're telling me people are still buying? Well, interestingly enough, yes, but it really depends on where the 10-year treasury falls. So as this chart is rate locks for Fannie Mae and Freddie Mac by Walker and Dunlop compared to the 10-year treasury rate. And you can see when the 10-year, which is the average 10-year is the blue line, when that dips below 4%, you see activity spike. People start rate locking like crazy. When that is over 4%, really that 3.75%, people are skittish and they don't rate lock. So what that tells me is that people are comfortable to a certain point. They want at least equal leverage, not negative leverage going in, meaning that the cap rate that they're buying at is higher than the fixed rate loan that they're taking on, but that there is a point of equilibrium where people can get comfortable at a 10-year treasury rate around 4% with a spread on top of that of, call it 200 basis points. So an all-in rate of 6%, people are still buying. It just, what needed to happen was cap rates needed to catch up to the greater market so that people felt comfortable and they felt like they weren't getting underwater and under levered day one. So a couple of thoughts for 2024. I know we're kind of pushing up on time here. Don't believe everything that you see. This is the Fed. This is the rate cut and rate hike estimated chart. This was 1 week apart. And if you dig into this, between those 2 weeks, there was some bad economic data. And it went from, oh, we're going to have a bunch of rate cuts to about half the rate cuts in 2024. So not even the people that are making the decisions know what they're doing. So we can use this type of data, but honestly, the Fed has been the worst predictor of Fed activity in the history. So do not believe what you see because it can change week to week, day to day. It's all coming down to the economic data, like inflation. This is the forward rate curve. This is another example. This was from January 2nd, 2024. You can see it's a very steep downward slope. 2 months later, well, there's a couple of speed bumps in there, and it no longer looks like it did, even what they predicted. I mean, they were saying that by January 2025, the Fed funds and the 10-year would both be below 4% back in January. Now that number is over 4.5%. So recession, soft landing, maybe an opportunity. So this is the base case from CoStar. Again, this is market price growth by property type. Hard to know exactly, if this is going to prove true, but some general thoughts on each asset class that we play in. Just overall, we think that commercial real estate investment activity will pick up in the second half of 2024. Office is struggling and will continue to struggle because I'm in my home right now giving this presentation. The fact is that there's just too much office space that's being underutilized. And so there's just a limit and a ceiling on what that sort of redevelopable product can be. And so it's hard to, I don't know what the answer is in office, but I can tell you that it just will not be the return driver that it had been over the last decade plus. Although we do think retail, their fundamentals are fairly strong, mostly in part because no one's building new retail. That's really in part because we overbuilt retail over the last 10 to 15 years. But we do expect that if the economy slows and we do hit a more sector-wide recession, that retail will feel it first. We do think industrial is healthy. Net absorption remains on par, although we have seen that slip here in 2024. So I think we'll see, so long as not as much product comes online, we do think that the fundamentals for industrial will prove strong. And then interesting for apartment supply, well, we think the fundamentals are good. The largest wave of supply is hitting the market as we speak. And I'll actually dive into that here. Especially in certain markets, mostly in the Sun Belt, you can see that there are a ton of new supply coming online for apartment buildings in these markets. And so while the fundamentals have been good, I think we'll see a period where it takes actually a fair amount of time for certain markets to digest all the new supply. And the net deliveries will outweigh net absorption, which will bump the vacancy rate. And so you'll actually see rents come down, which we've started to see already, before we see them kick back up, but once everything gets absorbed. So you can see the numbers here for apartment construction over the last 3 years, really unprecedented, right? People saw the opportunity, they jumped in, and there's just a lot of supply coming online. So here's a couple of certain markets that I pinpointed. I don't know how much national business you all are doing, but Atlanta, Charlotte, Austin, and Phoenix have tons of supply coming online. Their vacancy rates are already in the double digits, and asking rent growth is declining on a month over month and year over year basis. So this goes back to PwC drops a survey every year called Emerging Trends in Commercial Real Estate. So this was 2023's magnet markets. And you can see it's concentrated in the Sun Belt, Florida, and Texas, where all that new supply got built and is coming online. And now they pivoted. A number of those markets are no longer in their magnet markets to watch. So Tampa and Miami are now gone. Charlotte is no longer in there. Looks like Austin has been removed. So clearly there are some issues in certain markets that we have to watch that could lead to a more broader sector-wide pull down in apartments. But overall, again, we do feel like it's a pretty safe asset class. 2024, the year of more forced transactions. There's almost $930 billion worth of maturing debt coming due. Some of that will get kicked into 2025, no doubt. But a lot of these folks have to act, and that means they either have to sell or refinance. Refinance is going to be painful so long as rates stay high. And so there could be there will be more forced sales. The question is, who will be there and at what price are buyers willing to transact? Again, there seems to be a sweet spot so long as the 10-year is within that 3.50 to 4% band. So as long as we stay relatively close to that, I think you'll actually see, again, second half of this year, more apartment building sales. This is just a little blurb from that same PwC survey. The difference between debt capital availability for acquisitions. You can see it was oversupplied in 2022. You can see it trended toward undersupplied and imbalance for 2023. They haven't yet released this for 2024. My gut would tell me that it would be heavily skewed toward undersupplied because a lot of the banks are on the sidelines. And so we're just seeing less and less lenders who want to be in the space overall. So a couple of my own personal predictions, and we'll wrap. Multifamily and industrial will remain the preferred asset classes for investors. And I mean that for institutional and private. They have the strongest fundamentals. They have the longest tailwinds, and especially comparatively to the rest of the market, they're just the most attractive investments. So as you're talking to your clients, my recommendation would be to make sure that you're familiar with both industrial and multifamily apartments, because that's most likely what they're buying. Retail also as sort of a distant third. I think they'll perform well, but again, if the sector gets dragged down because of a slowing economy, they feel that first, and so it can be a little bit painful, more so than the other asset classes. This is true in single-family homes. Also, cash buyers and 1031 exchangers are best positioned, right? So they have the most leverage, they have the most amount to negotiate with, because the cost of debt has reduced competition across the board, especially for larger luxury and trophy assets. And then this one is really interesting. I think we'll see this play out. We already have seen it play out, but debt funds and other private equity alternative lenders have brought in such a big amount of debt capital to the marketplace, which has backfilled what the banks are no longer financing. And so there is as much capital as there has been historically, but it's where banks used to be at least 50% of the market for both single family and commercial real estate. I think that private lenders will now make up a much larger percent of that and have grown in popularity. And then in addition to that, subordinate debt, which is structured as both preferred equity and mezzanine debt, tons of that will have to be deployed just to make acquisitions pencil, because you need more leverage to buy at the current cap rates with the current cost of senior debt. And then this is just a personal opinion. I'd love to hear your thoughts, but I think pricing for assets will actually be lower in the first half of the year. As people get more and more comfortable transacting and competition heats up, it will drive the price and the bids for assets up. And so I think if you are a buyer, you're better off actually coming in now, possibly paying maybe a slight premium, even, if you can't if you can't get the seller to meet you in the middle, but you're better off negotiating just with the seller rather than having to bid against 20 other buyers, which I think may actually happen come the second half of this year. So a couple of actual transactions. These are both multifamily acquisitions that we financed. The one on the left was in Greensboro, North Carolina. This was a Fannie loan. Fixed rate. They were going to do some value add renovations, but they wanted to lock in their rate. So we got them almost 70% LTV on a 7-year fixed rate term. We locked rate on this one actually late last year. That one was in the high fives. I think we locked at 568. So pretty incredible with 5 years of interest only as well. So really, really strong execution there. Fannie and Freddie both continue to be super competitive in multifamily financing. The one on the right needed more leverage. So Fannie and Freddie were out, but we used a debt fund who offered a fixed rate bridge loan. And then we put a subordinate note behind it in the structure of mezzanine debt. We ended up getting 90% loan to cost. So on a $30 million acquisition that they were going to put about $4 million into, the total loan amount ended up being about $28 million. So not a lot of equity deployed, really good, transaction, high leverage, some risk there, but the borrowers were comfortable with it, so they took it. On the left here is an industrial building. This is actually in Santa Clarita. We refinanced it, about a 60,000 square foot building, 10-year fixed rate term, 30-year amortization, just, solid, great industrial property. This is the bread and butter of what a lot of our clients are looking for, looking to buy and hold. And then on the right here is, it's a pre-leased retail property in Colorado. You can see the tenants are Bank of America, Jersey Mike's, Great Clips, and Dunkin' Donuts. This is a construction loan that our client will be building. So we are financing the construction of it at 65% loan to cost. It's full recourse with the personal guarantee to the borrower. But construction financing is still out there. So if you have clients that are looking to build projects, we are still getting them done. So I know that was a lot. I hope there are a lot of questions or thoughts. I'd love to hear them. And thanks for letting me share and participate in all this.
Well, that was great. I have a question. So on the multifamily side, with all the volume that you guys do and the amount of financing that you do, when you talk about some of these assets that are come up, you're going to push some of the debt, refinance to 25. I mean, of the stuff that you're doing, I mean, how many of those finance deals are going to come up short that, people can't afford to stroke a check and make the difference? Because I know a lot of my clients, especially in places where, LA City or South Pasadena, where there's no room to grow the rents, they've been stroking checks. They're lucky enough to be wealthy enough to do that. But are you forecasting some real big problems with stuff you guys have financed in that area too? I mean, what the solution is?
Yeah. So I mean, yeah. So the solution is it's a cash in refinance, right? And that means either you're writing the check or you're bringing on a new investor or a new partner who's writing that check. But I don't forecast any problems per se. Look, if you are an owner of multifamily over the last 5 years, your rents have gone up for the most part, maybe not in LA City, depending on the rent moratorium and how much you're able to push. Even in LA City, you can do CPI plus 3%, right? So you should be able to get 8% a year. So you've done very well. The only real problem that I see is if you bought in, say, late 2021 at peak pricing and took a floating rate bridge loan at a ridiculously low spread and SOFR index that is now resetting, and you are so far underwater that rent growth doesn't even sniff how far underwater you are. That's where I think we've seen a couple of big givebacks already nationally on some syndicated deals. And that's where I think the majority of sort of problem child lives. But if you're just an owner operator, especially if you own a property for a long, long time, you've done very well, right? I mean, some markets had double-digit rent growth for multiple years running. So I think while it hurts to write the check today, you've done so well that you can rationalize doing it because it's been a good investment. You want to keep it, and you also aren't getting the price on a sale today that you probably want. So you're better off writing that check. So it's a difficult conversation, no doubt. But yeah, there are a lot of folks that are coming up short just because where with rates are today, you're not maybe getting to what your loan needs are or what your existing balance of your loan was, depending on when you took it out.
Awesome. Thank you. Anybody else have some stunning questions for Andrew?
Hi, Andrew. Do you offer kickbacks?
We pay referral fees, and we are happy to do it with all of our agent partners and broker partners. So we can have feel free to reach out to me offline. Every transaction is typically a little bit different, but we do pay. So let me talk about our fees. So we're hired by the borrower, typically on an exclusive basis. We are paid a percentage of the total loan amount funded. So on a $10 million loan, we would get our percentage of the fee. And then we would be happy to pay a referral as a percentage of our fee to you all right off the top. The only issue is we do have to pay KW Commercial. We can't pay you as an individual. We have to pay the corporation, the brokerage.
I'm already a mortgage broker through C2 Financial. So
that works. We just have to pay C2. Yep.
Yeah, exactly. Okay.
But yeah, happy to do it. We do, I don't know, 15%, 20% of our business is referral based from brokers. And so we are paying, referral fees monthly. Happy to do it.
Thank you.
Mm-hmm.
Any more questions? It's a lot of information. That was great. I really enjoyed that. I was thinking in my mind about the transactional volume and negative leverage, right? Cap versus how much I'm financing for. And do you think, in your experience with even with the in-house salespeople, what you guys do, that part of that's been education to the public about, I've been looking at pricing out my multifamily at 4% for the last 3 years before all this happened. And all of a sudden I've got to swallow a 6% cap rate if I want to get this thing off the market. Yep. And they're just not budging because they're like, no way, I'm not going to do that. And the buyers are saying, investors are saying, well, I'm not going to do that either. Boom, no sales volume, right?
Yeah, no doubt. I mean, look, there's sort of two pools of people today, right? There's the haves and the have-nots. And if you're an owner, again, you've done well. If you're an owner with good debt and low fixed rate debt, of course you're not selling, your cash flowing, right? So there's no reason to sell. So the deals that are hitting the market typically have some sort of distress, and it may not be property level distress. It might just be debt distress, right? They're looking at the check that they have to cut to stay in this deal because they have to refinance, and they're going, well, why don't we just sell it, right? So someone else can come in, but that seller, doesn't want to sell a fire sale because it's not a distressed asset, right? So there has to be some meeting of the minds. And what we've seen for the most part is that buyers are willing to accept, some risk of negative leverage, assuming that there's upside within the property, right? So they might go in, they might buy at a 5.5 cap with 6% fixed rate debt, but there's a path to getting that 5.5 cap up to a 6 and a 6.5 within 1 to 3 years, right? And on a 7 to 10 year business plan, that's a short time to be negative levered, especially if you get interest only maybe during that time to ease the pain of that negative leverage. And so then the rest of that business plan, you're cash flowing at and above with positive leverage, and you feel pretty good about it. That's where we've seen all the institutional partners and players go. Now, it's different for a private investor if you're buying your first asset. That's a pretty big risk to take, I think. But if you're a seasoned investor and you have, proof in the pudding of doing value add renovations and jumping rents, and you can create that value, then I think there's going to be a lot of assets that come to sale that, again, you want to negotiate early before before the secret's out, and a lot of people start realizing they can do the same thing.
Great. That's all I got. Anybody have any other questions? Mike Hardy, come on, give me a question.
Yeah, absolutely. So if I were an agent who wants to work with you, in my day-to-day, obviously real estate agents speak with everybody. They want to have conversations about real estate. What are some of the things that in a normal conversation that an agent is having with a client, what are some of the things that an agent could hear a client say that might tip them off towards being in a category that this is something that maybe you would be able to help team up with the agent to provide some solutions to those clients?
Yeah, totally. Well, I think the first thing that I always recommend with agents and brokers is to, do your best to ask as many questions about the client as possible, which includes, what other properties do you own already, right? You sort of profile them. Are they buying just duplexes? Are they buying retail strip centers, right? What you'll find is that a lot of real estate investors tend to gravitate towards one asset class, and they have success in that, and they keep building on it. So someone that owns multifamily typically will continue to buy multifamily, and they continue to look for those types of properties. So know your buyer and know sort of what you're looking for. And then really what it comes down to is being able to add value to that client, right? So a lot of folks, especially if they've been buying multifamily here in Los Angeles, they've been using bank financing because it's very abundant and it was very competitive for a long, long time. But right now, that's not the case. And so a lot of folks that will go to their bank and say, hey, Mr. Banker, I'd like to go out and buy this new property. I know we've done 3 deals prior, and this is going to be great. And the bank says, actually, we're really not in the market right now. And so that then leads to a need where someone like I can step in, and there are other banks that are active, and there's also Fannie and Freddie, which the buyer may not be aware of, for something like that. So I think just understanding the needs of your client, listening for those cues, and also understanding, where the opportunities are and being able to talk about them, right? So again, the most I'd say sort of easily digestible for real estate investors to understand is multifamily, right? It makes sense. We've all rented an apartment, and then sort of most people have transitioned into buying a home. So they know the differentiation. And then the other asset classes, though, being able to talk about industrial, being able to talk retail, and pointing out some examples of why they might be easy or maybe more passive to run, and listen for cues of where you can add value in that relationship. But I would say if you have a client that is looking at or talking about buying a commercial property, that's a great opportunity to say, well, are you working with a commercial lender? And if not, would you like me to have someone take a look at this and give you some quotes or thoughts on what the financing might look like? And just leave it at that. And they might say no, they have their existing relationships, and they might say, yeah, that would be really helpful to understand, so I can understand how much of a down payment I need to put in, or what my monthly cash flow might look like with a certain type of loan, et cetera. So the majority of our job is spent up front looking at properties. Just like when a client's buying a house, it's pretty rare that they put an offer in on a house and it's accepted and they buy that house and then everything's great, right? Sometimes they're putting offers in on 20 houses and it takes a year and a half. And so we're doing the same thing with our clients. They're looking at 40 properties and they are putting in bids on them, right? And so we're quoting all of this as we go, because they need to know real time what the debt might look like on this project, or what it might look like if they did this. And so that's what we're here for. The only caveat I would say is that our minimum loan amount tends to be about $1.5 million. And so these should be larger projects when we get involved. So if you think about, 8-unit multifamily in Long Beach probably runs $2.5 million purchase price today. So that's probably right on the cusp of where a loan amount might be at $1 million, $1.5 million. So something like that would be, a great introduction, or anything larger than that. Anything smaller than that, it's probably a little harder sell for us.
Got it.
Thanks.
Great. Thank you. Yeah, you definitely hit the nail on the head with that multi-unit property in Long Beach that I ran by you. I think that was last week. But yeah, I just, at least while I'm talking, I just want to say one of my favorite things about working with you, Andrew, is every time I have a scenario that I run by you, your email responses are just so incredibly educational. I feel like every time I just ask to see if you can do something, whether the response is yes or no, I walk away learning something that can help me earn more business in the future and have better conversations with my clients going forward. So thank you for that.
Well, I appreciate that. Thanks, Mike. Thanks for your partnership.
Amazing. Thank you. Jason, did you have any other news or updates you wanted
No,
to
no updates from the land of KWI. We're all safe until next week.
Okay. Anybody have any listings they wanted to shout out before we hop off? Oh, actually, David Yashar did ask me to put his flyer in the chat, so there you go. But if anyone has anything, feel free to share with us. And remember, you can always email me your information and we'll post it on our KW Commercial Instagram and Facebook. So it's a great way to get the word out.
Hey, Jason, I got a request here to send the presentation. Do you want me to send it over to you and you can distribute to the whole
Yes.
team? Would that be easier?
Yeah.
Okay.
Send it over to me. I'll make sure everyone gets it.
Awesome.
Awesome. Well, thanks, Andrew. I got a hard out right now, but thank you so much.
Thank you for having me. I appreciate it. Look forward to working with all of you. Feel free to reach out to me. And Jason, if you wouldn't mind, just send my contact details along with the presentation so folks can reach out direct.
Yes, sir. Sounds good.
Andrew, is your phone number 310-979-5756?
That's it.
Okay, thank you.
Thank you, everyone.
Thanks, Kim. Thanks for setting this up.
Have a great day.